Right, good morning. Who else wish to record? Right, there are three students recording. I think that's good enough. Right, we get started. Last week we stopped at this slide. Right, last week we stopped here. Now we deal with case 3. Eleanor Preston, the CIO of Porter William Investment, right? Okay, medium-sized firm has been trying to retain a difficult client, right? Kobe Company. Management at a disgruntled client, right? Disgruntled, that means not happy, right? Which accounts for almost half of PWI's revenue, recently told Preston that if the performance of its account did not improve, it will find a new manager. So shortly after this threat, Preston purchases MBS for several accounts, including Kobe's. Preston is busy with a number of transactions that day, so she fails to allocate the trades immediately or write up the trade tickets. Right. So a few days later, okay, this is what okay, this is what it was done, right? So Preston was busy with a number of transactions that day, so she fails to allocate the trades immediately or write up the trade tickets. All right. So a few days later, when Preston is allocating the trades, she notes that some of the MBS have significantly increased in price, right? So some have increased in price, some has dropped. So Preston decides to allocate the profitable trades, right? So only the profitable trades goes to Kobe, right? And the losing trades, to the other accounts. So this is not fair allocation, right? Not fair allocation, right? So you cannot say this is a systematic approach, right? Right, and there's no pro rata allocation. Okay, there's no pro rata application. Okay, so and also there's no disclosure of the conflict of interest here. That's the other point. Okay, but the main thing is about the fair allocation of the trade here. Okay, right. The main issue is the fair dealing and transaction allocation, which is located here. So these are just comments, right? These are not answers to the question because there's no question, right? So here basically, within this comment, we're asking this question: Has she violated? Yes, because she has failed to deal fairly, right, in the transaction allocation, right? So these are just some of the comments, I mean, suggestions, what she should have done, right? Should have, right? She should have done. Okay, so basically, like allocating the trades prior to executing the orders, right? Or you must have a systematic approach, So what kind of system? Maybe you can say pro rata, prorated according to the number of shares that they currently hold, right? That is what is meant by pro rata. So, and also, as you say, among other things, right? So the main thing is about the transaction allocation. So other things, right? You must disclose, that the advisor may act as broker for or receive commission, and, disclosure about this potential conflict of interest, right? Because there's some agency cross transactions here. So there's some potential conflict of interest here. So there must be some disclosure here. Yeah, this in a way would be fair dealing, right? you know this is also part of fair dealing. You must make the appropriate disclosure, right? So disclosure should be written, right? So, and also, just to safeguard yourself, you must have client consent, you know authorizing, such transactions. This is to safeguard you. That's so this is to appear even more fairer. Right, case 4. Now, the issue here is about selective disclosure. All right. Okay, so that means there's only partial disclosure, or you're only disclosing to certain parties, right? So Saunders Waste Management, right, publicly indicates to analysts that it is comfortable with the somewhat disappointing earnings per share projection of 115 for the quarter. That means for the next 3 months. Okay, Bernard Roberts, an analyst at Coffee Investment, is confident that SIWM management has understated, right, understated the forecasted earnings, so that the real announcement will cause an upside surprise. So because of this understatement, right, and if you report the actual earning, right, it will be it's something more than the understated, because it was understated in the first place. So if you just report the real earnings, it would appear to be like something like an upside surprise. All right. Okay, that means it's like a positive news, and this will definitely boost the price of the stock. Right. So, when they say this whisper number, right? So this whisper number is whatever figure, regarding these earnings, right? Whatever figure was, like a rumor, they call it whisper number. That means like people gossip, about, or they try to anticipate what the earnings are. So the number, right? The amount, right? So whisper number, estimate based on extensive research, and some people, some may have done some research, or they may have discussed among so-called knowledgeable analysts, right? So the whisper number is higher than this figure. So, yeah, this is 115. So, right, so here basically Robert, right, repeats this number in his research report to all coffee clients. Okay, but informally tells his larger client, right? So that means this is tantamount to selective disclosure, right? So he informally tells his larger client. So this is selective disclosure. That he expects the earnings to be higher than 115, so making SIWM a good buy. All right. So, right. So this is a key part. He's informing his larger clients about, the expected higher earnings, right? Right. The so-called upside surprise. Okay, the earnings per share to be higher, right? So this is the upside surprise. Okay. So yeah, he is definitely not treating his client fairly, right? Because, okay, so this is the issue here, as I've said. Right, case 5. Now, the issue here is additional services for select clients. Right. So Zheng Ping Wang, right, uses email to issue a new recommendation. So uses email, so that means he's trying to be fair, all right? So he then calls, right? So he then calls, that means after he emailed, right? He see the English here, he then calls his 3 biggest institutional clients who had paid premium fees to discuss the recommendation in detail, right? So the keyword is then, right? He then called, right? So basically he used email. So yeah, I mean, this is not written by me, but and in fact the English here is not that clear, right? So but here he uses email. So here the presumption here is that he has emailed before calling his 3 biggest clients. Okay, so in this instance, if you have done that, right, it's still fair, right? So there's public dissemination, and then you know, he calls them because this is the additional service, right? This calling part, right? And this select premium, they had paid premium fees, all right? This select clients. So this is fair. So has he violated? No, right? Because he has already emailed, widely disseminated, right? Prior, right? Prior to discussing with a select few. And this select few, they have paid premium fees. Okay. So these select few are the largest clients, right? And they receive this additional personal service, you know, because they have paid higher fees. Okay, usually if they are big, right? Usually they would have tend to have a larger amount of assets, right? Okay, all right. So you get the point. So this is fair. Now here, right? Just to I mean, emphasize the point, right? So if Weng, right? The keyword is if had discussed a report with a select group prior to, right? Distributing it. So this part is the email part, right? If he had done this, then he would have violated. Okay. Right now we'll talk about the standard 3C, right? Suitability. Okay, suitability. Right, suitability. So, I mean, the objective here is to make sure that the investment recommendations that you're making, right, are suitable for the client. So in order to do that, right, you have to make a reasonable inquiry into the client's or prospective client's investment experience, his background, right, his experience. Ngô Hui Ting is coming in. Right, his experience and what are his risk return objective, right, and obviously his financial constraints, right? So this is the picture of the client that you must have. Okay, so and then before you make any recommendations or take investment action, right? So I mean, because this is an ongoing process, right? Okay, this part here, this reasonable inquiry is an ongoing process. So if it's an ongoing process, you must reassess. So the keyword is re. right? Reassess, and the other keyword is update. Reassess and update. So you got to review, right? You got to review this information, right? All this information regularly. Okay, I hope that's clear. Right, and then I mean, this is about the constant review, right? So here B, right, determine that an investment is suitable, right, to the client's financial situation, right, and definitely, right, consistent with the client's written objective, what mandates, what he wants you to do, and his constraints. Prior, again, to doing anything. Okay. Okay, and then judge the suitability of investment in the context of the client's total portfolio. Now here, this part here, that here means, right, the additional investment, because the client would already have a portfolio. So that means you're trying to add new investments to the portfolio, right? So when you add investments to his existing portfolio, you have to determine on issues like correlation, you know, right? So that means you're always talking about the return, the risk return trade-off of the total portfolio. Okay. Right. So, okay, this is also second point, right? Now, if you're responsible for managing a portfolio to a specific mandate, right, strategy or style, right? Right. So usually this mandate, style, or whatever, right, they will have stated objective and constraints. So here, right, so your specific mandate, right, must be consistent with the stated objective. All right. Must be consistent with the stated objective here. Okay. Right. So, right, I already talked about these 3 points, right, in the previous slide. Okay, suitability. So these are the 3 points of this standard. Right. Okay, so the issue about managing to a specific mandate, right, and also make sure that you're consistent. Right, whatever recommendation you make are consistent with the stated objective and constraints. Right, so these two actually means almost the same thing. Okay, but it's worded slightly differently. Right, suitability. So you carefully consider the needs, circumstances, what he needs, right? So here you can see needs, right? It's not wants, right? So needs are something more basic. Okay, so you start with the basics, needs rather than wants, right? Needs, his situation, right? The circumstances, what his financial situation is, and what he wants, right? His objective, his goals. Okay, what he needs basically is more current, right? The objectives also, it could be current and the future as well. All right, so you have to determine all this. You have to carefully consider all this. When you determine whether your investment or cost of investment action is appropriate or and suitable. So that means you have the first step, right, is to gather information, right? And you do a suitability analysis, right? As to whether, this given investment is suitable or this course of investment action is suitable, all right, prior to making a recommendation or taking investment action. Right. So it is best to have something written, right? So we usually call this the IPS, right? The investment policy statement, right? It should be written, right? So you should incorporate this, right? And what this statement basically do is, right? I mean, from the information that you gather, right, you will know the client's risk profile, right? So risk profile, and this is combined with the return, right? The risk return trade-off, risk return profile, right? What is his return requirement like? And obviously his financial constraints. His money is limited. So investment constraints as in the amount of money he can put in and the time, right? So he will need to meet his objective within a certain time period. So he's constrained by his financial resources, and also there's also a time frame. All right. So this is what is meant by investment constraints. And also probably he would like to invest in certain assets. So this is also part of constraints as well. Right. So with this IPS, right, you basically can judge whether a particular investment or strategy is suitable for a client. Okay. And obviously, after you've done all this, you need to do periodic review, right? Because the investment process is dynamic. It changes all the time because circumstances changes. So that's why a periodic review is necessary. Okay. Right. So, and right, just a bit more. I'll talk a bit more on the investment constraints, because investment constraints is quite critical to what you mean by suitability, right? So, right, these investment constraints, right, could include things like or issues like number of dependents, you know, or his personal tax status, his health, his liquidity needs, or even his risk tolerance level, so limits, right? And besides talking about the amount of wealth he has, and maybe his compensation, his income, okay, things like that. All right. So, I've just talked about investment constraints for an individual. So you can also have investment constraints, right, for an institutional client. Okay, institutional client, probably you talk about the magnitude of unfunded liabilities in a pension fund. A pension fund is an institutional client, right? Or even maybe the withdrawal privileges in an employee's savings plan, or maybe even the distribution requirements of a charitable foundation, right? So these are all institutional clients. Okay. So the investment constraints are quite different, individual client and an institutional client. Right. So another key important thing is you must have effective suitability review, right? Okay, so to do that, right, your client should have full disclosure, must tell you not everything, but enough for you to know, right? So this is what is meant by full disclosure. And, you know, for you to have effective suitability review, right, you must have periodic update. Okay, it must be updated regularly because the investment process is dynamic. It changes all the time. Right, and so right, so this point is very important for this point. Okay, only with full disclosure, right, can we be responsible for assessing suitability of an investment, right, given the information and criteria provided by the client. So if the information and criteria given by the client is not full, then you cannot do an effective suitability review. Okay, are you with me? Right, so these are just some of the recommended compliance procedure to make sure that you adhere to this standard. Okay, so now, first and foremost, right, it is important to have a written IPS. So, and among the items that should be in the IPS are these 4 areas, right? So, client identification, right? By these, we mean, you know, the type and nature of client, whether this client is individual or institutional, right? Whether they have separate beneficiaries or dependents, right? And and also the third item, right, is the approximate portion of total client assets. How much assets he wants to put in. Okay, so this is what is meant by client identification, right? So by investor objectives, right? Okay, first is probably return objective, right? Return objective, right? Return objective, what sort of income he wants, right? Or growth in principle, or whether he wants to maintain his purchasing power, right? And then objective also, probably you can talk about risk tolerance, right? Suitability, stability of value, how stable are the investment that he wants to go in, okay? Right, and then investor constraints, right? You talk about things like liquidity needs. Okay, what is his expected cash flow? You know, money in, money out, expected cash flow. What are his investable funds? What kind of funds that he can allocate for investment? Okay, what are his time horizon? Tax considerations. Uh, Maybe he's even subject to regulatory and legal circumstances, right? Or maybe we can talk about investor preferences, his prohibitions, his circumstances, and his unique needs. And also investor constraints, you can talk about proxy voting. I talked about proxy voting earlier, right? Proxy voting responsibilities and guidance. Okay, things like that. Okay, so this is right. And then what are the performance measurement benchmark? What sort of return he wants? Does he is he using the market as a benchmark, or does he want to perform better than the market? Okay, so you know what are benchmarks, right? So, and then the last thing is you must have periodic review. This is very important because the investment process is dynamic. Right, sorry for the noise. Right, so this case, right, case one, investment suitability. So we talk about the risk profile. You see whether this risk profile matches your investment recommendation. right? This investment advisor, right, Glad Smith, right, has two clients. One is Larry Robertson, 60 years old, and the other is Gabriel Lanai, 40 years old. Okay, both clients earn roughly the same salary. Okay, but Robertson has a much higher risk tolerance. So they're different, right? Because he had a large asset base. Okay, Robertson is willing to invest part of his assets very aggressively, and Lanai wants only to achieve a steady rate of return, right, with low volatility to pay for his children's education. Okay, Smith recommends investing 20% of both portfolios. Right, this is the key part. Right, you see, yeah, I mean, you see, Robertson is different from Lanai, right? Because Robertson has got a higher risk tolerance, okay, and he can afford to be very aggressive, okay. Lanai wants low volatility and he wants a steady rate of return. But this part here, Smith recommend investing, 20% of both portfolios, right, in the same item, whatever this is. Okay, so this recommendation, right, may be suitable for Robertson, right? This is suitable for Robertson, but not for Lanai. Okay, not for Lanai. So in other words, right, now you can say, right, the two clients' financial circumstances and objective differ, but he's recommending the same strategy, for for these two clients, right? So this is a clear-cut case of investment unsuitability. Okay. Yeah. So as I said, right, yes, it is suitable for Robertson, right, because he can afford to be aggressive, right, but not suitable for Lanai because Lanai wants something more stable, right? So going back to the previous slide. Now, this is zero yield, small cap. Usually small cap stocks are very risky and these are high tech issues. So these tend to be new companies, untested, right? So nevertheless, these are high risk company. This is a high risk, right? Very high risk. Right, so that's why you can conclude, right? Smith is violating the standard, by applying Robertson's investment strategy, right, to Lanai. Okay, because the two clients' financial circumstances and objective differ. Okay. Now, can you hear me? Can you hear me properly?